Welcome back, everyone. And this week we will be studying chapters 3 and 4 of the text for lesson 2. Chapter 3 introduces the double entry accounting system. We've talked about it, but here we get into it in some detail. In order to accurately capture the vast number of financial transactions that a business engages in each year, a system was invented or introduced over 500 years ago. We call it the double entry system. It is somewhat like the traffic laws that keep cars and people flowing in Los Angeles. Yeah, right. Red means stop, green means go. In our analogy, we use those would be our debits and credits. Debit means left side, credit means right side of a T account. We'll get into that. We begin with the accounts. An account is an individual record of increases and decreases in a specific asset or liability or equity item. We saw a list of accounts used in the balance sheet report in Chapter 2 on page 75. It would be good to refer back to that page at this time. Note that there are three classes of accounts: assets, liabilities, and equities. That's it. For teaching purposes, we display these as T accounts, so called because they resemble the letter T. In actual practice, these accounts are managed by computers and no longer take a physical form until it is time to report the account balances. The terms debit and credit refer to the left side and right side, respectively, of each T account. The fundamental accounting equation guides us when recording increases and decreases in an account using debits and credits. For all asset accounts, a debit represents an increase, while a credit shows a decrease in that account. Both liabilities and equities are exactly opposite, with credit entries showing increases and debits showing decreases in these accounts. Asset transactions are categorized as source, exchange, and use transactions. The text gives several examples of each. Note that every transaction involves two or more accounts. One account is debited and the other is credited. We call this system double entry bookkeeping. Note also that each transaction is presented in horizontal format that emphasizes the accounting equation. This is to help you understand the effects of each type of transaction on the financial reports. The process of generating data to be entered into the accounts begins with source documents. These include sales receipts, invoices, checks, time cards, deposit tickets, and so forth. Every transaction must begin with and be backed up by a source document. These are stored until they can be legally shredded, generally for a period of 2 or more years, as dictated by the IRS. Each transaction is recorded in a journal, which is called the Book of Original Entry. This allows the accountant to track every transaction chronologically, in time order, that is. The increases and decreases for each of these transactions is then transferred to separate accounts. The collection of all accounts is referred to as the ledger of accounts, and is therefore called the Book of Final Entry. The process of transferring the data as debits and credits from the journals to the ledger accounts is called posting. When this is done, a systematic cross-reference is also generated and recorded so that each account can be traced to a journal entry and the transaction, which can be supported by a source document. This process allows auditors to check the accuracy and reliability of the financial reports based on the accounting records of the business with a high degree of accuracy. The trial balance is a tool for checking the accuracy of the accounting record. It is based on the fact that total debits and credits recorded in the ledger of accounts should be equal or should balance, hence the term balancing the books. At the end of each accounting period, that is at least once a year, the accountant closes the temporary accounts by transferring their balances to permanent accounts using closing entries. The final balances are recorded in the financial reports. A trial balance is performed, and the cycle begins anew. Finally, the authors introduced the subject of financial analysis by showing how the accounting records and reports can be used to judge the financial health of a business. The purpose of Chapter 3 is to give a conceptual view of the recording and reporting process. The actual bookkeeping is done by computers. The work was once done by hand and involved much more clerical labor than it does today. Chapter 4 shows the accounting for a merchandising business. These are commonly called either retail or wholesale businesses. A key feature of this type of business involves accounting for inventory. Take note of the learning objectives in the chapter found on page 188. We start with a discussion of the perpetual inventory system. Later, we will introduce alternatives. Our goal is to accurately measure the cost of goods sold. The difference between revenue from sales of inventory and the cost of that inventory as it's sold is called gross margin or gross profit. We then subtract selling and administrative costs from this figure to find taxable income. After paying taxes, we are left with what is called net profit. The goal of every business is to make this final number as large as possible. Economists call this activity profit maximization. The balance of the chapter details transactions affecting inventories and sales and their effects on the income statement and balance sheet reports. Well, there you have it. I hope this gives you a solid introduction to the topic, and we will enjoy discussing it with you when we meet at class. Don't forget the following class is third week in January, a holiday, and we will be responsible for the chapters therein, but we won't meet. Bye-bye.